Could one say short squeeze at all?
I guess potentially.
Potentially? I don't know. I just don't know why it's higher.
Yeah, I don't know. It's really kind of fascinating. The VIX has come down. You know, we are talking about, Creedy pointed out, about a 1,265-point swing on the Dow, so about a 5% from peak to trough, about a 5% move on the S&P 500 peak to trough.
1,000 points on the Dow.
I would argue that these are the kinds of things that you start to see when we are trying to find a market value, a market bottom, kind of incredible selling or incredible swings, like kind of back and forth. So I don't know. That's my take on it, but we'll see, I guess.
Victoria Green yesterday from G Squared, she was in the studio with us. She said she's still looking for 3,200 to 3,400 on the S&P 500 for a bottom. So, yeah, we'll see.
The other thing is,
no one knows.
I mean, at some point, investors are not stupid. Like, how many Fed officials have to come out and say, folks, we've got high inflation. We are going to keep raising rates. We know we're concerned about other things. So at some point, investors price that in. I mean, we're down, we're up for the first, day in 6, I think.
Yeah.
So we've been down for a while.
Hey, let's get on over to world and national news. Nancy Lyons is in Washington, D.C. in our 99.1 newsroom. Hey, Nance.
Thanks, Tim. There are multiple reports. The House committee investigating January 6th that's meeting today will take a vote on whether to subpoena President Trump to testify. This afternoon, committee members have been summarizing their findings, with Congresswoman Zoe Lofgren saying they have documentation that months before the election, Trump was planning to declare victory regardless of the outcome.
We now know more about President Trump's intention for election night. The evidence shows that his false victory speech was planned well in advance, before any votes had been counted.
Lofgren says Trump was also ready to declare that only votes tallied on Election Day would be legitimate. Well, the U.S. Supreme Court is handing former President Trump a loss in his fight over records the FBI seized from his Mar-a-Lago estate. The court agrees with the government that a set of materials with classified marking should be excluded from a special master's review. Well, President Biden says his economic plan has the U.S. in a better position to tackle inflation than the rest of the world. The White House put out a statement after the latest report on consumer prices showed core inflation hit a new 40-year high last month. Commerce Secretary Gina Raimondo says the plan needs time to work through the economy.
I wish there were a magic wand. The fact that every country in the world is struggling with inflation, and frankly, America is doing better than any other country, tells you there's no magic wand, and we have to get up every day and attack it.
Commerce Secretary Gina Raimondo spoke on Bloomberg Radio and Television. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nancy, thank you so much. Nancy Lyons in our 99.1 newsroom in Washington, D.C. So we just talked big time about inflation, right, with our TV colleagues.
It's still happening.
Yeah, and specifically shelter costs, which Brian Deese of the National Economic Council for the White House making some comments about that. Housing costs shifted into overdrive last month and risk becoming an enduring source of U.S. inflation. This is our story out there by Molly Smith.
Yeah, she's on our eco team, and I saw her earlier today. She's just been covering these numbers all day, digging into what's happening. She says that rent of shelter and owner's equivalent rent each accelerated 0.8% in September from the prior month. That's the most since 1990, according to Labor Department data released on Thursday. Both measures posted a record 6.7% advances on an annual basis.
That contributed to the biggest year-over-year increase in overall shelter costs, which also includes hotel stays and tenants and household insurance since 1982. Housing, by the way, everybody, makes up about a third of the overall basket of consumer prices, which we know rose last month by more than forecast, and it comprises an even larger share of the so-called core CPI, which also exceeded estimates. And the report cited shelter, along with food and medical care, among the largest of many contributors to the broad advance in September. And I think some of it has to do with higher mortgage rates mean people can't afford homes. We've also had, for a while, supply chain constraints with housing because there just haven't been enough houses out there for people to buy. They've gotten more expensive. Yeah. It's more expensive if you take out a mortgage. And so if you can't buy a home, you're going to be renting.
I think that's why a lot of the conversation when it comes to this shifts to policy and to think about what moves local governments make, what moves state governments make, and what moves the national government makes to make it easier to build in parts of the country. California, for example, in recent years, huge housing crisis in that state, pushing for ADUs, accessory dwelling units, also known as, grandmother houses, I think they're called, to be allowed to be built on property. which could add millions of homes to the state.
You know, and we're going to hear a little bit from my conversation with the co-head of global real estate for Blackstone. They are certainly taking initiatives when it comes to affordable housing. This is Bloomberg.
headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Wild ride on Wall Street, best level of the day. Stock surge. We have got the S&P now up by about 3%. Lots going on as we head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. A massive turnaround for equities. Despite that hot CPI report, Dow's currently up 937 points, was down 455 points. S&Ps, like you said, are higher by 105, and NASDAQ climbs by 2.6%. The U.S. 10-year yield at 3.95%. Gold is lower by 6. Oil is climbing. And Bitcoin trading higher by 1.4%. Among the main 11 S&P sectors, leaders were energy, financials, and technology. Leaders to the upside in the Dow, Walgreens, JP Morgan, and Chevron. After earnings, Walgreens is up 6.4%, BlackRock 6.5%, and Delta gains 4.9%. In deal news, Kroger is said to be in talks to combine with rival Albertsons. And in other news, Netflix to introduce an ad-supported service at $6.99 a month. Wrapping things up, U.S. mortgage rates surged to the highest in 20 years, reaching 6.92%. Live from the First and Breaking News Desk, I'm Bill Maloney.
Okay, we thank you very much. Bill Maloney into here live. Breaking news over your Bloomberg type squawk. SQUAWK on your terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, today, Bloomberg Live hosting a second day of Bloomberg Invest. It's an annual gathering of the leading names covering everything from crypto to credit markets and then everything in between. And it was in person for the first time since the pandemic and comes amid, as you know, an era of lots of market volatility and uncertainty. I caught up with an executive from the largest owner of commercial real estate globally, Kathleen McCarthy. She is the global co-head of Blackstone Real Estate, which has a $577 billion portfolio and about $320 billion, that is, in investor capital under management. Lots to talk about. We began, though, when I asked her how, against a tough market backdrop and daily mixed signals, how things are going.
It is an exciting and interesting time because, as you can see, there's different signals coming through, and I think we are better positioned than anyone to know what's really happening. We have $600 billion of real estate. We're in 37 different countries. A portfolio, though, that's highly concentrated into 4 key themes. 80% of our capital is in warehouses, rental housing, lab office, and hospitality investments. And what I'd say we're seeing is actually very strong fundamentals in those sectors. So when you talk about property performance, particularly for rental housing, that continues to be strong, partly because of the pressures on the for-sale market with rising interest rates. Logistics demand, so warehouses. In the U.S. today, we're at record low vacancies, less than 3% vacancies in the markets we operate in, which are the densest, most urban kind of areas. And we're also seeing very strong rent growth. So in the U.S., last month, rent growth in our markets was 30%. Wow. In Canada, it was even stronger, 50%. And so I think when we're thinking about the real estate market, we continue to see a lot of strength, notwithstanding there are pressures around us in terms of interest rates, an economy that the central governments are, of course, trying to cool, and persistent inflation. But we feel really well positioned for that. And I'd also highlight that I think this moment in real estate, this cycle is quite different than others we've been in the past.
Different good, different bad.
I'd say good, different. I mean, good, different. When you think about what kind of led to real estate downturns in the past, there were really 2 primary factors. It was too much capital, generally in the form of debt, creating greater leverage, fueling new speculative development, and it was too many cranes, too much development. And really, when you think about what happened in the years following the financial crisis and leading up into COVID, we really never saw those excesses come into our market. And so as we head into a period where there may be more economic headwinds, real estate actually is really well positioned from a fundamental standpoint.
Economic headwinds or recession?
It's very hard to call, and I'm not.
Why is it so hard?
I think part of it is what we're seeing, and some of the things that I think the central governments are trying to combat, which is just this continued strength. They see low unemployment, strong rent growth, and that is part of what the big challenge is ahead. So I don't know if we're going to have a recession. I'm not an economist, but I would say there's definitely economic cooling.
Are you guys having conversations internally, like thinking like, hey guys, we need to be thinking that maybe in this market,
Yeah, what I would say is we've been planning for a long time, and this comes through in the portfolio we've constructed for an environment that might have been like this in terms of higher interest rates, higher inflation. And so we really focused on trying it to be in those high cash flow growth assets. And again, I'd say today we're still seeing those stronger than inflationary cash flows in our portfolio. But certainly, we are always trying to position for environments that change. We've been doing this for 30 years. We've seen a lot of different environments. We thought we had seen it all, and then COVID hit, and hotel revenues went to zero. I'm telling you, no one underwrote that before we had a pandemic. But the great news is our portfolios are built really to try to withstand any kind of environment. And the higher than anticipated rent growth we've experienced, again, may kind of come down modestly, but we feel really well positioned for that.
And distress for you guys can be opportunity, big
Definitely.
time. We saw that after
Yeah.
the financial crisis in terms of housing.
I would say environments with distress, with volatility, with a pullback in capital markets activity, and we're seeing in particular much more constrained capital markets today, that tends to be a great environment for us and really for any investor who is well capitalized and who has real strengths to lean on. So we have a data advantage. Our portfolio gives us more information on what's really happening. That helps us build conviction around what we want to do next. And then I'd say the combination of deep experience from a large team and capital makes us well positioned to really support situations where others may be needing to sell assets, others might need liquidity, and we're able to then get in and buy high quality real estate.
All right, that was a conversation earlier at Bloomberg Live, their Bloomberg Invest event. Kathleen McCarthy, global co-head of Blackstone Real Estate, massive portfolio, as I mentioned, largest owner of commercial real estate. We covered a lot of ground. We could have talked for another 30, 40 minutes easily, but there's a lot more to that conversation. You can find it at BloombergLive.com and just search on Bloomberg Invest. We're good, what?
Well, I'm eager to see what they do in this environment. Like
Yeah.
when they start seriously deploying more capital, when they see valuations come down enough to do that.
But they are really good at picking up distressed assets. They bought a lot of residential housing after the financial crisis. Casino in Vegas, the Cosmopolitan, picked up for a song. It was beaten up, and then they, sold it and made a really strong profit on it.
So what does this cycle look like?
Opportunity she sees globally around the market. They really double down on warehousing and distribution. She thinks there's going to be more of it, and that was something that was a play pre-pandemic and played off and paid off really well for them.
Think about the consumer shift.
Yeah,
we've seen during
exactly.
that time.
And then as you have more companies coming back, and
Yeah.
they're going to need, distribution facilities like we talk about nearshoring, onshoring. That all plays into it. We're going to have another conversation from Bloomberg Invest. It's all about crypto. Tim did that last night. You'll hear from that in just a moment. This is Bloomberg.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, so we've talked about the wild ride that we've seen on markets. We talked about stocks selling off, then rallying, and then we did see treasuries tumbling. We saw 30-year yields over 4% for the first time since 2011. We're going to talk about the yield curve and also what Fed fund futures are telling us about Fed policy.
You know who knows a lot about this?
Ira Jersey.
He's going to be joining us in just a few minutes. But first up, let's go over to Charlie Pellet because we got less than 90 minutes to go, Charlie.
Indeed, stocks holding on to gains. The Dow, the S&P, NASDAQ all surging, with the S&P on track to halt a 6-day sell-off that took it to a 2-year low. Right now, we've got the 10-year yielding 3.95%. We've got the 2-year 4.45%. All of this on a CPI Thursday. The S&P up 99 now, a gain of 2.8%. A 3% surge for the Dow, up 882 points at 30,092. NASDAQ is up 251, up by 2.4%. Of course, we've got a whole lot more coming up on rates with our Ira Jersey. Spot gold right now, $16.65 the ounce, down $8, a drop there of 0.5%. And West Texas Intermediate crude up 2.2%, $89.17 a barrel. A key measure of household prices rose to a 40-year high in September. Core consumer prices up 6.6% year over year. The data pressures the Federal Reserve to lift rates even more to stamp out inflation. Biden administration reaction to today's report from U.S. Commerce Secretary Gina Raimondo, who was interviewed right here on Bloomberg Radio.
As we all know, this is a global problem. There's not a country on earth right now not struggling with inflation. And as we put COVID behind us and get back to business as usual in the supply chain, I think, the Fed's action will start to have an effect and consumers will continue to feel it. But it takes a bit of time for the Fed's actions and the supply chain actions that we've taken to work its way through the system.
And again, we do have the 10-year yielding 3.95%. Goldman Sachs and Apple have announced a partnership to offer savings accounts to users of the tech company's credit card. Goldman Sachs shares, they are advancing today, up 4%. Apple up by 2.8%. And this headline now from the Bloomberg Professional Service: the January 6th panel probing the Capitol attack has voted to subpoena Donald Trump. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, wild market ride today. Equity markets, bond markets, that's for sure. We did, as I mentioned, saw treasuries tumbling. We did see that 30-year yield over 4% for the first time since 2011. We had policy-sensitive 2-year yields also surging as much as 24 basis points to 4.53%. That was the highest since 2007. There's been a lot of stuff going on today.
I got to turn my microphone on
It's
sometimes,
that kind of a day, right?
Ira Jersey's with us. He's chief U.S. interest rate strategist for Bloomberg Intelligence. He joins us on the phone from New Jersey. Ira, we've been trying to explain the equity market for the last hour and a half, and now we have you on the program to try to explain what's going on in the bond market because the signal's a little more clear there. What are you seeing?
The equity signal is, or if the equities are signaling anything, it's a little bit baffling to me. But in the rates market, it's pretty simple. Inflation seems like it might run a little bit higher than the market was thinking. So a lot of this bond market sell-off is, as Carol mentioned, in part policy rate sensitive. Right, we're pricing in another, maybe a 75 basis point interest rate hike, not only in November but in December. And then on top of that, you have inflation expectations that have jumped. So 5-year inflation expectations have jumped about 8 basis points today, and 2-year inflation expectations have jumped almost 20 basis points. So you're seeing a pretty significant increase in inflation expectations after today's report, and I think that's a reasonable market reaction, quite frankly, because the data this morning, as we all know, was higher than expected, but the details, I think, were really telling in that inflation might take a long time to come down, even if it has peaked, which I think it has. The glide path is not going to be nearly as steep as the market was pricing.
Hey, I think it was something you said earlier, I thought, on Bloomberg, Ira, which is when you look at market expectations for the terminal rates, that investors still think that the hiking cycle, or traders, that the hiking cycle will stop by March. Is that still the case?
Yeah, so the hiking cycle, the market is still thinking will stop by March, and then I think what's more baffling, it's not so much that they might stop by March, because I think that we'll have a pretty good idea about what the glide path is, and if the Fed does hike 75 and then 50 and 50 and 25 or something like that, then they're going to get close to 5% plus or minus 25 basis points. Then I think that the question is, that and what the market might have wrong is that the market currently thinks that they're still going to start cutting interest rates very early. There's still an interest rate cut priced into 2023, and I think that that's something that's not likely to happen. I think once the Fed reaches their terminal rate, it'll take some serious market reaction, and in particular, inflation coming down significantly more than I think that it likely will, in order for the Fed to start cutting interest rates. But once they start cutting, say in 2024, 2025, they probably will cut pretty quickly. So the market kind of has it wrong, I think, on both ends. One, it's pricing for cuts too early, and then two, it's not pricing for enough cuts later. And I think that's one reason why I still think that the yield curve has more flattening to do, which, it's already very, very inverted, but it could get even much more inverted from where it is right now.
Hey, Ira, what about when it comes to what the Fed needs to see in order to start cutting? When you say inflation needs to come down significantly, what are we talking here? I mean, are we talking they have to wait until it gets to 2%? Are you saying that, what are you guys thinking about at Bloomberg Intelligence?
Yeah, it's a good question, Tim. So I think one of the big thing is it has to be trending the right direction, right? So if inflation on a year-on-year basis, comes down and let's say it's at 5% and the Fed funds rate is at 5%, that means you have a neutral Fed funds rate. And anything then if inflation comes down just a little bit more, everyone will start to say, okay, policy rates are now restrictive. And keep in mind, the Federal Reserve has always hiked until the federal funds rate was at the same or higher than the personal consumption expenditure deflator. So until we get to that point, and we're not quite there yet, the Fed will likely continue to hike interest rates. So they need to see that the core PC deflator, I think, coming down. Now, if it's 3.5%, it looks like it's going to 2% over 6 months, then yeah, the Fed might start to think about about cutting interest rates a little bit, particularly if the unemployment rate is higher. But right now it doesn't. The labor market's still so tight. It's hard to imagine the Federal Reserve cutting until you see a couple of percentage point increase in the unemployment rate.
So glad we could talk with you. Ira, thank you so much. Ira Jersey, he is Chief U.S. Interest Rate Strategist at Bloomberg Intelligence, joining us on the phone from New Jersey. And as we speak, you've got the 10-year note with a yield of 3.95. Looking at the shorter end of the yield curve, that 2-year note specifically, right now yielding 4.46. Both are off their spikes that we saw in terms of the yields earlier today.
Well, let's go to Washington, D.C. now for a check of the latest world and national news to our 99.1 newsroom with Nancy Lyons. Hey there, Nance.
Thanks, Tim. The Supreme Court is refusing to intervene to reinstate a special master's authority to review a set of classified documents that were removed from former President Trump's Mar-a-Lago estate. It's a win for the Justice Department that had argued that Trump had no legal interest in what were clearly government records. The House committee investigating the attack on the U.S. Capitol wants to hear from former President Trump. Members have been summarizing their findings this afternoon, and they wrapped up today's hearing by passing a resolution put forward by Congresswoman Liz Cheney.
I am offering this resolution that the committee direct the chairman to issue a subpoena for relevant documents and testimony under oath from Donald John Trump in connection with the January 6th attack on the United States Capitol.
Congresswoman Liz Cheney argued the duty now is to the Constitution, and every American deserves to hear from Trump. A Florida jury has determined Nicholas Cruz's life should be spared, and he should receive a life sentence without parole for the murder of 17 at Parkland High School in 2018. Jurors concluded while there were aggravating factors that led Cruz to the shooting, there were also mitigating factors like severe mental health issues. Parkland parent Fred Gutenberg disagrees with their decision.
They gave their personal beliefs, but they didn't go by the evidence. There was no mitigating factors. I'm sorry. Any mitigation was disproven clearly in the court.
Gutenberg says the jury failed the families. The decision comes at the end of a 3-month trial that included graphic videos, photos, and testimony concerning the massacre. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Nancy Lyons in our D.C. newsroom, obviously focused on inflation news this morning and the market reaction. In the meantime, we're seeing some special situation activity going on, and this has to do specifically with some of the big supermarket chains.
Yeah, we've got a great deals team here, including Michelle F. Davis, Ruth David, Ed Hammond, and Crystal C., all pitching in on this story. A Bloomberg exclusive, Kroger saying to be in talks to combine with the rival Albertsons. This deal, if it would happen, would create a U.S. grocery giant, according to people familiar with the matter.
So it's so funny. You were like, darn it.
Yes, I'm so frustrated because this was one of my decliners, Kroger, but shares are now higher by more than 1%.
It's funny because I looked at them too, because Albertsons is rallying big time, so it's one of my gainers, but I looked at Kroger to see what kind of market reaction. So at some point, investors are either, first of all, it's either getting caught up in the market, move to the upside, or investors are saying, you know what, this consolidation of 2 supermarket giants, maybe this could be a good thing for the acquirer as well as obviously the target.
Kroger was down earlier, and it only recently went higher, and it's only up by about 1%, so it's underperforming the market.
But still, interesting that the acquirer, right?
Yeah, like usually it's lower, and that's what it was earlier today, even when the benchmarks were higher.
Yeah, so I think it's kind of interesting. I mean, soaring food prices are a key driver behind inflation in the U.S., while industry consolidation has given top players in the space much greater market share. We'll have to see whether there could be political and regulatory hurdles for this kind of tie-up, as politicians blame corporate greed for higher prices, while antitrust officials eye tougher merger rules. So you don't know whether some of that might put an end to this or make it more difficult.
We should know representatives for Albertsons and Kroger could not immediately be reached for comment. This potential deal, though, would be among the largest U.S. retail transactions in years, and the biggest U.S. supermarket deal since the last time Albertsons changed hands. That was back in 2006. It was bought by SuperValue, CVS Health Corp., and a group of investment firms for about $9.8 billion.
Kroger, by the way, is the number 2 grocery seller with a 9.9% market share. Albertsons is 4th with 5.7%. I believe atop the list is Walmart with about a 21% share. All right, you're listening and watching Bloomberg Business Week on this Thursday, and this is Bloomberg Radio.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. U.S. stocks holding on to gains ahead of the close here with the Dow, the S&P, and NASDAQ all advancing. S&P on track to halt a 6-day sell-off. The S&P right now up 97. That is a gain of 2.7%. The Dow higher now by 873 points, an advance of 3%. We've got NASDAQ up 242 points, a gain there of 2.3%. Stocks came storming back from losses sparked by that hot CPI reading this morning on speculation the year-long sell-off has potentially reached a bottom. The 10-year yield 3.94%, the 2-year 4.46%. Gold down $8 the ounce, down 0.5%. Bitcoin up 1%, 19,367. West Texas Intermediate crude up 2.1%, 89.07 a barrel. The key takeaway here, we've got the Dow back above 30,000, 30,091 up now by 3%. S&P up 2.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right. Speaking of going crazy, we're all a little bit crazy about today's market, trying to understand it. We keep getting lots of emails, and thank you, everybody, listeners in the Wall Street community and others who are saying, here's what we think is going on. So we're going to continue to track. And we've got another voice to tell us what he thinks about the trade, because we are definitely well off our lows and big swings in the equity averages today.
Big swings today. Dave Donabedian is Chief Investment Officer at CIBC Private Wealth Management. Dave joins us this afternoon on the phone from Baltimore. Dave, good to have you back with us. How are you?
Doing well. How are you?
We're doing pretty well. We're kind of scratching our heads here quite a bit, thinking about today's equity trade. We had some great comments from Ira Jersey earlier, giving us some insight into what's going on in the bond market. How do you look at things?
Well, you'd love to think this sharp turnaround was because everybody took a second look at the CPI report and said, gee, not as bad as we thought, but we know that's not the case. It's bad. And the timing of the move, late morning, it was a rather sort of violent turnaround to the upside, and usually that suggests some kind of programmatic or algorithmic buying. So I think that's part of the story. We're down 6 days in a row. A lot of the sentiment indicators show we were sort of at extreme levels of bearishness. The bull bear ratio coming into the last couple of days is about as low as it ever gets. So it may have just been an oversold market.
Okay, I mean, I'll take that as good an explanation as any.
You don't sound like you got conviction behind it, though, Dave. I mean, does it feel, it's funny, I just put out a Twitter poll and I'm asking everybody, again, stock market bottoming.
Are you tweeting during the show?
I'm a multitasker. Okay. And the majority of responses say, no, it's not a bottom, almost 53%. About 18% say yes, and about 30% say no idea, and I had hashtag volatility. So it is, what does a market bottoming look like? And can we say that the market bottoming that we are likely to see this time around is going to be same as what we've seen in the past? Because I do wonder how the pandemic and all the liquidity that was pumped into the markets kind of changes what it looks like.
Right. Yeah, I don't think a day like this signifies a market bottom. Obviously, we had a really strong market from mid-June to mid-August, and it was just a bear market rally. But, I think we're certainly closer to the end than the beginning of this bull market, and we've really identified three things that need to fall into place to feel confident that a new bull market can begin. And we're just to sort of do a progress. The first one is we need to see clear evidence that inflation has peaked and is on a downward trajectory. Safe to say we're not there yet. The second one is we need to see a downside surprise on expectations for the Fed funds rate. Now that's kind of interesting after today because we're getting there. Our view has been that the Fed funds would need to go to 5% next year, which was way high on the consensus list. But that's about where the market is now. So we're making some progress there. The third one is I think there needs to be a more realistic outlook for corporate profits, right? The current estimate still calls for an 8% increase in corporate profits next year. That's kind of magical thinking to me, given the economic environment we're likely to see. So this sounds counterintuitive, but I think we actually need to see earnings estimates come down for us to feel that they're appropriately valued before we can really begin a new bull market. So we're a ways away from it, I think.
How much do earnings estimates have to come down, in your opinion?
Well, right now they're expected to be up about 8% versus this year, the 2023 numbers. I think we'll be really lucky to be flat in 2023 versus 2022, and more likely slightly negative. So, so they need to come down another, we'll call it 8 to 10% to say, gee, this is realistic.
It's interesting too that you were talking about downside expectation on the Fed funds rate, and I'm looking at the warp function on interest rate probability, world interest rate probability for the United States. And we were just talking to Ira Jersey, who thinks that pricing cuts that are being priced in right now by the markets, he thinks they're pricing it too early. In other words, that the Fed stops raising rates. He thinks it's going to be later rather than earlier. And he also says they're not pricing more cuts to come later on. Do you trust kind of market indicators right now at this point? Do you feel, here we have a 5% swing on the S&P and the NASDAQ today, and the Dow, excuse me, and yet the VIX comes down. I don't know how to explain that.
I can't explain it either. I think in terms of the path for Fed funds, again, our view has been they funds peak at 5%, probably in the second quarter next year. The work function, as you mentioned, is saying that's about what the market now thinks. But I think that the missing piece may be that we go for a multi-month period where whatever the peak is, let's say it's 5%, it stays there. And the Fed watches. You talk to a lot of market participants, and there's an assumption that, well, the Fed's going to, do their final rate hike at one meeting, and the next meeting they're going to start to lower rates. I don't think so.
Yeah.
So I think we're going to be stuck at that rate for most of the second half of 2023 as well.
What would you be buying in this environment?
Well, I think, the equity market, our advice generally has been to go slow in terms of putting money to work because, as I said, we don't quite think we're at the bottom of this bear market. We are focused mostly on dividend payers and those companies that are still going to be able to grow their dividends, through this difficult economic environment. Defense contractors, infrastructure stocks, healthcare are some of the areas. Small caps continue to be quite attractive on a valuation basis. Now, they're not going to be immune if we continue to be in a bear market environment, but they may be what leads us out when the bull market begins.
Go ahead, Carol.
No, go ahead, please.
So Dave, Carol asked what you'd be buying. I want to know, I know you tried to explain when you'd be buying here, but in terms of time frame, how long are we going to be sort of, searching for a low here and kind of just treading water in the S&P?
I think for a couple more months. Again, impossible to know exactly, right? But I think we've got a couple more months of this sort of sloshing back and forth, and probably with a little bit of a downward bias. But as negative as we may be on the economic forecast, we're actually pretty positive about equity prospects for 2023. We're likely to see a recession begin, probably sometime in the first half of 2023. But we know from long history that the stock market tends to bottom in the middle of the recession, sometimes even in the early stages of the recession. It doesn't wait till the recession's over. So we do think things are falling in place for a better market for equity investors, but it may not be till next year.
If you had to make a choice, U.S. versus non-U.S., where would you go right now?
Short-term U.S. If you're a longer-term investor, non-U.S. You've got truly inexpensive valuations, and so I think with a 1 to 3 year view, non-U.S.
All right. Well, good to know, and certainly something to think about on a day where we're all trying to make sense of another volatile day with lots of swings. Dave Donabedian, thank you so much. He's Chief Investment Officer at CIBC Private Wealth Management, joining us on the phone from Baltimore. So we've got just about almost 2 minutes, 40 seconds left in today's trading session. We are hovering near our best levels of the day when it comes to the equity trade. So what does that mean? We're up 2.6, almost 2.7% on the S&P 500, up 859 points on the Dow Jones Industrial Average. That's good for almost a 3% gain. The NASDAQ also, it is up 2.3% in today's trade. But again, keep in mind that we were down more than 2% on each of these major averages earlier in the session.
I know it's not the end of the week, Carol, but we're actually up over the last 5 days on the Dow in the green.
That would be interesting to see if we end up higher. All right, folks. Coming up next, we'll be joined by our Bloomberg TV team for Beyond the Bell on radio, TV, and YouTube.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to the closing bell, and here to help take us beyond the bell. It's our global simulcast. We're joined right now by Carol Massar and Tim Stenevik. We welcome our audiences across Bloomberg Radio, television, as well as on YouTube. A wild day, Carol.
Yeah.
I mean, we started off deep in the red here on the markets, but I should point out the low on the day on the S&P 500 was at 9:33 a.m. So 3 minutes into this session, about 2 hours after that, we were in the green, and right now we're not far from the highs of the day.
Yeah, pretty remarkable, right? We're really hovering and holding on to these gains that we've had, and it was quite a swing. I've been looking at the bank sector, the KBW Bank Index. It's up more than 5%. Let's not forget, we're going to get big bank earnings. JP Morgan leading it off tomorrow, but a lot of enthusiasm ahead of those results and definitely some outperformance today.
We talked big picture with Dave Donabedian, the Chief Investment Officer at CIBC Private Wealth Management. He said, we're going to be sloshing around like this, like we've been doing for a couple more months, back and forth in the S&P. But he's overall pretty positive about what equities look like in 2023. Even though we could see a recession, we could see the bottom of the S&P 500 in the early or middle part of that recession in the first half of next year. So overall, glass is half full for him.
Yeah, we're hearing similar. Just got to get through March, right, to find some stability further out. That echoes sort of similar comments. We just had Lori Calvasina on over at RBC, fresh off a revised note that she just printed, hot off the press. Looking at a downgrade now for the price target for this year, closer to 3,800. Previous forecasts were for 4,200. So, Tim, that really speaks to the sloshing around as we try to count down to this year end.
Correlations break down, though, today. In fact, they work for once. Remain bonds go lower, stocks go higher.
Yeah, interesting to see whether that sort of correlations or rather that sort of decoupling to a certain extent actually holds here going forward. We're getting the closing bells here in the market. It is an update pretty much all around. The Dow Jones Industrial Average higher by more than 800 points or 2.8%. The NASDAQ Composite higher by more than 200 points or 2.2%. And the S&P 500 going to close higher right around that 3669 level, up about 92, 93 points or about 2.6%. The widest trading range that we've actually seen on the S&P 500 since January 24th, 194-point swing, and that's the second highest swing that we've seen on the S&P 500 from peak to trough, both on a points basis and a percentage basis since the big breakdown back in March of 2020. Russell 2000, not to be left out of the party here, up, Carol, by 2.4%.
Yeah, I mean, all in. And if you dig a little bit deeper into the S&P 500, we're going to get into industry groups in just a moment. But the S&P 500, almost all the names, 471 higher in today's session.
Okay. That's good. That leaves like, what, 30 for Tim?
Yeah, it's been a struggle.
I have to tell you, he's been stewing here. He's like, I can't find any decliners.
Sometimes you got those days,
stewing
right?
for me, because, Carol, my day is also very easy. When you take a look at the sector winners and the sector losers, it is all green on the screen all day long. Let's start with some of the big winners given this banner day. It's banks, it's energy, it's dividend financials. We've talked a lot about the yields that are jumping. Banks are benefiting somewhat from that. Sprinkling in there, technology, hardware, semiconductor, some of the software and services, those are also catching a bid of about 3% as well. There were some, I guess we'll call them losers. They're underperformers. They're only up about 0.5%, even though they're in the worst performers column. It's food and staples, and it's consumer durables. It's the retailers as well on this big inflationary day.
All right, let me get to some of the gainers. I had so much to choose from, but I did go to Biogen.
Way to rub it in.
Giving you a hard day today.
Yeah, no, you really are.
All right, Biogen top in the S&P 500, NASDAQ 100. Stifel upgrading it to buy from hold, saying skeptical skepticism surrounding its new Alzheimer's drug seems overdone. They set a new price target of $299. It closed at $269 and change. But remember, at the end of September, Biogen rallied, almost 50% after some key clinical trial data came out showing its Alzheimer's therapy slowed the progression of the drug, of the disease. But nonetheless, that Stifel call giving another boost to Biogen today. Domino's, we talked about it. We know why. This stock up 10% in today's session, top of the S&P 500. It was a mixed quarter, but their U.S. comp sales topped the average analyst estimate, so better than some had feared. At least that's the words that Citi used. And then Albertsons, let's go there because we could see maybe potentially a big tie-up in the supermarket space, rallying. According to people familiar with the matter, Kroger said to be in talks with a tie-up with Albertsons. If so, it would create a U.S. grocery giant. Albertsons up 11%.
Well, yeah. What? Well, the key word there is if so. There was actually a great note out by Morgan Stanley, Simeon Gutman, talking about the potential
regulatory
antitrust
concerns,
issues that they might be up against, particularly with this administration.
Yeah, we'll see what happens.
Yeah.
All right.
All right, let's go to the decliners. Slim pickings, as you mentioned, and actually, Taylor, you did a lot of the work for me earlier, talking a little bit about consumer discretionary stocks being at the bottom right here. Amazon down 0.3%, weighing on the S&P 500. Also, Etsy finishing the day down by 9.3% among the categories, too, in consumer discretionary. And then rounding it out, we got Match Group down at a record low today, down 5%.
Have people stopped dating?
I don't know. You know, we're going to have to wait to find out details unless they do any sort of pre-announcement because we're not getting earnings
because
from
we're
that
all
company
married
until the 1st of November.
Meanwhile, I'm totally missed on a commodities front. Did you see it?
Everyone just walked away from that one.
You were like, okay, you're married, bye.
Let's get on, moving on.
Don't bring our partners into this, okay?
Yeah.
Wow.
Can I bring candy into the situation? Did you see that candy prices leapt about 13% in the inflation report? Let's talk about some other commodities, because candy is a commodity in my household. We're currently seeing Brent crude up 2%. In fact, commodities across the board had a good day. We were higher on the Bloomberg Commodity Index, natural gas up more than 4%. Look, if you thought your inflationary pressures were going somewhere, not so. If you're looking at oil prices back at $94.65 on Brent, we're up at 89 on WTI crude. So managing to get a bounce at the moment. That is perhaps US dollar does roll over somewhat, and we see strengthening across the board. Maybe some of the injection of risk-on attitude came a little bit from the UK in the last bit of trade. We saw the sterling up, strengthening 2% in terms of cable levels. We're seeing the likes of UK bond markets actually outperform as the Bank of England really tries to ride to the rescue here. And most notably, there's talk about a U-turn coming from the government in terms of some of those tax policies. We're looking at the euro strengthening 0.7%. As I say, the Bloomberg dollar index up by 0.4%. And look at that, the 10-year gilt, as we see, yields down 23 basis points, Taylor.
It was another story here of price lower, yield higher, and a huge rate of change kind of day, Carol. The two-year yields, we've definitely wiped out the year-to-date highs. Now looking at a two-year yield, the highest we haven't seen since August of 2007. You jump 19 basis points on the day up to a 448, as really many are now thinking a terminal rate of closer to 5% is now the goal. Just to round it out, a 10-year bond auction, I think, that came today, decent on the 30s as well. 10-year yields the highest now since 2010. So you're really getting some of these multi-decade highs.
Yeah, and maybe that's why banks spiked overall, or maybe there's expectations. I find it's interesting that J.P. Morgan, I think, was up 5 or 6% here on a day where, you had Jamie Dimon come out with some concerns about the economy, but those stocks really riding high in today's session.
One interesting thing, though, about some of those comments, not just from him, but from a lot of folks, is, and I think we kind of touched on it at the top here, and also with our previous television guest, Lori Calvasina, this idea here that while there is going to be a lot of pain over the next few months, there is general consensus right now that maybe by the time we get to the end of 2023, things will maybe be a little bit more right-sized. And I feel like some people are maybe looking all the way ahead to the second half of next year as a reason to justify some of the valuations out there today.
I'm still trying to understand the position the consumer's in right now, and that's what I'll be listening to when we get bank earnings in the coming days, and then also next week as well. Because you get news from Domino's like we got today, and we got the news from Pepsi like yesterday, and I'm wondering if this is,
but
people
that's Pepsi and Domino's.
I know, so I'm wondering if they're trading down, right? Actually, the Domino's CEO had some interesting commentary about being concerned about delivery in an inflationary environment, saying, okay, well, delivery could struggle because of tip, but carryout could actually succeed more.
So just in the past few days, so you get the sort of generally upside out of Pepsi and Domino's. We heard from LVMH, who said people at that end are doing well here. What about in the middle? What happens?
Airlines still doing well. Delta, maybe.
Yeah, maybe.
signal there that people are still willing to be doing traveling. I thought in the inflation data it was meant to be showing that our mobility, our transport costs were actually coming down a little bit.
Yeah, interesting. Don't forget we're going to get a read on retail sales tomorrow as well, so that'll give us some other clues.
Thank you.
Okay, you're welcome. You'll get my bill. All right, we got to wrap, guys. We'll be back again. Cross-platform coverage, radio, TV, YouTube. We will count you down again, same time, same place tomorrow.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
You know, it's funny, you talked about bank earnings and you want to hear from them. I do. I want to see what JP Morgan. Jamie Dimon, though, said a lot. There's just a lot on the terminal already. Brian Moynihan, we had this story coming out on Wednesday, and he said the American consumer is in good shape. Those were his words.
That's what I'm talking about.
Spending more this month than a year earlier, even amid inflation, jittery markets, and international tensions.
Well, look, you have people still able to jump from one job to another job, which we know is the best way for people to get a raise.
Yeah.
We do still have an economy where there are more jobs available for people who are looking for them.
Yeah.
You know, we're at the time of year where I think people start to think about compensation and ask for raises. So
yeah. Still tight labor market.
Still a tight labor market. So that's why it's going to be great to hear from the banks.
Yeah.
About what people have in their cash accounts.
Well,
what are they spending on credit cards? Are they putting stuff? Are they paying their credit cards on time?
So here's what Moynihan said. The consumers basically have more money in their accounts by multiples than they did pre-pandemic. This was at the Institute of International Finance annual membership meeting. This was on Wednesday in D.C. Here's more of his quote. They're earning more money. Their credit quality is as high as it's ever been. They have more excess capacity.
It makes you think.
Yeah.
Because we're in an environment where inflation is higher than it's been in the last 40 years. We're not seeing that come down. We're all experiencing higher prices, but we're still paying for things.
So we'll see what the retail sales data says tomorrow. Like, what do we
Is
see?
that inflation adjusted, though?
I don't know. Do you know?
I don't think it is.
Okay. But still, it'll be...
Hey, I dish it back, okay?
You're allowed to give it back. The Twitterverse has said to me, oh, come on.
Yeah, they're saying that you're going a little too hard on me.
Just a little.
When Katie Greifeld's away, and she can't give me a hard time on our crypto show, you have to step in.
I do. Retail sales will be important. Bank earnings will be important. We'll see what they have to say. And, of course, you'll have all of the information you need right here on Bloomberg.
Let's get to world and national news into our 99.1 newsroom in Washington, D.C. Hey, Nance.
Thanks, Tim. The House committee investigating last year's attack on the U.S. Capitol is issuing a challenge for former President Trump. Members want him to come in and testify about the attack, and they've unanimously approved a resolution to subpoena Trump. Congresswoman Liz Cheney offered the resolution.
We must seek the testimony under oath of January 6th central player.
Cheney says the vast weight of evidence presented by the committee has shown nothing would have happened without Trump. The Supreme Court has rejected former President Trump's plea to step into the legal fight over the FBI search of his Florida estate. The justices did not otherwise comment in turning away Trump's emergency appeal to allow a special master to review the classified documents that were taken. The Justice Department had argued that Trump had no legal interest in what were clearly government records. We're getting the White House's reaction to another hot reading on inflation, the last one before the midterm elections. President Biden put out a statement saying progress is being made, but inflation remains a global problem. We spoke with top White House economic advisor Brian Deese.
The United States is in a better position than virtually any other country to address this challenge and do what is necessary to bring prices down without having to give up all of the economic gains that we have made.
National Economic Council Director Brian Deese. One positive side to inflation is that Social Security benefits are going up 8.7% next year. The cost of living adjustment, or COLA, is the biggest increase in 40 years. It'll amount to about $140 a month. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
Thank you so much, Nancy Lyons, in our Washington, D.C. newsroom. So, story by our Steve Dixon and Sri Natarajan.
I love this story.
I know, right? Why do you love it?
Because they're coming for everything.
Who, Apple?
Yeah.
Yeah, they are.
And I think to myself, wait a second, is Apple turning into like, and don't yell at me online for this comment,
oh, please
okay?
do.
But think about, the companies of yesteryear that turned into conglomerates, right?
You mean like a Citibank? I mean a
Or
supermarket?
a GE,
financial supermarket? Or an Amazon?
Back in the day when
Oh,
GE
right.
brought on financials.
Ah.
And I'm not saying that's going to happen to Apple, but at a certain point, growth starts to stall with certain product categories. And you need to figure out ways to, get that next $1 trillion in market cap.
Is it growth stalling, or you're just tapping into your universe and giving them more services?
Well, it's a good question, and more services that make it a stickier ecosystem, so you're
Correct.
guaranteed to buy another product from Apple.
I mean, in my house, like when it comes to devices, it's become very sticky.
But are you going to open a high-yield savings account?
I don't know. I
with
have
Apple?
I do Apple Pay already.
I do too, but that's like,
I know. It's
You
not
don't have
the
to
same
sign
thing.
up for that. You just set your, put your credit cards in your phone.
Yeah, I don't know.
Should we tell everyone what we're talking about?
Yeah,
It's
so-
been a full minute.
All right, so here we go. Sorry. Apple Card users will be able to open the new high-yield savings account and have their daily cash automatically deposited into it with no fees, love that, no minimum deposits, love that, and no minimum balance requirements. Apple's saying this in a statement today. Daily cash refers to the rewards that card users generate through their purchases.
The move builds on existing credit card partnerships between the two companies. The Wall Street Titan has pushed in recent years to expand its offerings for consumers, though the effort has been dogged by cost overruns and missed profitability goals. We talked about that with Sri earlier this week. For Apple, though, Goldman remains a key partner even as the tech company works to shift more of its financial services offerings in-house.
So is it just rewards, or is it real money that you're putting? 'Cause daily cash refers to the rewards that card users generate through their purchases. So is that what you were just putting in?
Yeah, but I would imagine you can also put more than just your daily cash. I'm not positive about that. That's not clear to me.
All right, stand TBD maybe, and just stay tuned because it does sound like Apple moving increasingly into the finance area. This is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. CPI Thursday. At one point, we had a 2-year low for the S&P 500 index, and then a turnaround, and stocks came roaring back. Today, the S&P 500 index ended with a gain of 92 points at 3669, up today by 2.6%. The Dow back above 30,000, 30,038 on the Dow, up 827 points, a gain today of 2.8%. NASDAQ up 232 points, higher by 2.2%. So stocks rallied after that hot inflation reading on speculation the year-long sell-off had potentially reached a bottom. 10-year yield 3.95%, 2-year yield 4.47%. Spot gold down $8 the ounce to $16.65. Bitcoin today up 1.5%, 19,463 on Bitcoin, and West Texas Intermediate crude up 2.2%, 89.19 a barrel. So again, recapping the Dow, the S&P, and NASDAQ all moving higher. S&P ahead of bank earnings tomorrow, up 2.6%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, Bloomberg Invest has wrapped up, but last night I ended up hosting a panel here. We discussed a lot about the wider adoption of crypto when it comes to asset managers and institutions. Carol, I don't know if you saw this news this week. Bank of New York Mellon launched a digital asset platform here in the U.S. It's the oldest bank in the U.S.
Wild.
And it's going to allow some clients to hold and transfer Bitcoin and Ether. So they're saying, you know, we'll be your crypto custodians.
The establishment, right?
Yeah, it's something that we
Leaning
talked.
in.
This is exactly what we talked about last night on the panel here at Bloomberg HQ. Taking part were Blue Machalari. She's head of digital strategy at T. Rowe Price. Puneet Singhvi is Citi's head of digital assets institutional clients group. We also heard from Bart Smith, the global head of digital asset strategy for Susquehanna International Group. Take a listen.
What we're seeing this time is that even though we're in another crypto winter, and we've obviously had this, this big drop in market cap, the institutions are still committed and moving forward with plans. And we saw the announcement yesterday from Bank of New York Mellon, which, everyone knew that they were working on this, but the institutional commitment is there in a way that it wasn't in 2018. And I think it is no longer, depending on who you ask, it's no longer an existential question on like, well, will crypto cease to exist?
Why is that institutional commitment here now and it wasn't here in 2018?
I think that it was such a new technology and a new space, and we saw what looked like a significant bubble, a run-up, and when the bubble burst, and the floor back then in 2018 was we're talking 6,000 as a price point for Bitcoin, so it was a huge drop, and I think a lot of people who were already skeptical said, okay, this is it, crypto is going to cease to exist. I think that institutions and the market more broadly has seen the way in which I think it's largely driven by retail and by, have embraced this and continue to stick with it. And I think that there's a real generational piece that people are starting to recognize as well.
Bart, jump on in here because you started in the current position that you're in, which is Global Head of Digital Asset Strategy at Susquehanna, December of 2021. So right as the air was starting to come out. What were the conversations that you guys were having about sticking with this versus saying, wait a second, this might not be something we should do?
So I was involved in kind of the 2016, 2017 phase. The firm has been involved in Bitcoin in particular for a long time, mostly just buying it proprietarily in kind of 2014, 2015. We did have a build out in 2017 of a desk that was providing liquidity for retail platforms and some limited institutional customers, the limited few that were there. And really what we've seen is this infrastructure being built out, right? So there's a lot of institutions, pensions, endowments, foundations who don't want to or can't practically use crypto native infrastructure, right? So even something like Coinbase, which is a very well-known name, it's listed, on the equity market. If you work at a pension or you work at an endowment, getting that on as a custodian is like a Herculean task. And so when you see firms like Bank of New York Mellon and State Street, with BlackRock announcement that they're going to have it on the Aladdin program, which the vast majority of institutions use as a critical piece of infrastructure. I think that's the piece that in Blue's comments that is different now. I've wanted to invest in it, but I don't want to have to set up new vendors and new fixed line connectivity. I don't want to have to get new software. I can't use a brand name custodian, and all of those solutions, while they haven't fully fixed themselves, you can see it on the horizon of that infrastructure being usable.
But Bart, where's the drive coming from? Is it coming internally or is it coming from clients externally? Like clients, and then of course their clients want access to it. Is that what it is?
I think that I think you're seeing from our perspective, right? Because we obviously trade in the spot markets, we trade in equities, but the kind of bread and butter of Susquehanna is derivatives, right? Futures and options. And you're seeing a world where, when you get to like a real kind of bona fide prime brokerage solution, where I can not only, cross margin my collateral for different crypto products by asset class and by, investment type, like so options and futures, where in the equity markets or traditional markets, they're all fungible. Now you're talking about real scale, and you're seeing real institutions who can do strategies, and it has the liquidity that they would need for like a Brevin Howard to run a macro fund or a D.E. Shaw and these brand names. They're not going to mess around in an asset class where they can get like $50 or $100 million liquidity when they need $1 billion of liquidity. And there's partners out there now like Susquehanna who can provide that. And so as these infrastructure things continue to get built out, you will see the types of strategies that people can run right now are growing.
You just heard from Bart Smith with Susquehanna, Blue Macellari of T. Rowe Price. Puneet Singhvi of Citi was also taking part. You can catch the full panel and more from some of the world's top financial executives. You can do that by going to BloombergLive.com and searching for our Bloomberg Invest event. That was just a taste of the panel that I moderated last night. It was about the wider adoption of crypto among asset managers and institutions. The first question that I asked to everyone after asking them if they all had crypto, which they do,
They do.
I asked everyone in the audience to raise their hand if they had crypto as part of their personal portfolios, and pretty much everybody in the room, including all three of those folks on stage,
Said yes.
Yeah, I mean, all the hands shot up. Like, your crowd, right? They're interested in it, so that was really interesting.
That's true.
I asked Blue, though, about whether the latest crypto crash should be looked at differently from the downturn of 2018, the last crypto winter, because she spent the last 5 years at a crypto-first hedge fund.
And?
She said it is different. Yeah, I mean, she said, look at all the institutional involvement that you're seeing right now.
I mean, you go back how many years, right? And everybody was laughing at it and poo-pooing it, and then to see them really step up in a big way.
But there are still a lot of skeptics, Carol.
Yeah, well, aren't you kind of a little skeptical?
I am absolutely skeptical.
Right,
Look at the track record here.
Right, and
It's
I think
short.
we need to be until we know a little bit more and regulators kind of weigh in. Amazing panel.
Thank you. You too.
Well done. Check out more at BloombergLive.com.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening and watching Bloomberg Business Week on this Thursday. Carol Massar along with Tim Stanovic. Really looking forward to our next guest. Nomi Prinz is going to be with us. She knows Wall Street well, has worked at so many different iconic firms. She's got a new book out called Permanent Distortion, How the Financial Markets Abandoned the Real Economy Forever. Can't wait to get into it.
Yeah, really great way to round out our show this afternoon. She's with us live in the Bloomberg Interactive Brokers studio. Let's get over to Charlie Pellet, though, because we got to catch up on all the after-hours action. Hey, Charlie.
Indeed, and let me focus first on what happened on Wall Street today. What a turnaround for the U.S. stock market, a wild ride today. We had the Dow, the S&P, NASDAQ ending the session very close to session highs. Look at the S&P up 92 points today, a gain of 2.6%. The Dow up 827, up 2.8%. And we had NASDAQ also roaring back from losses, up 232, a gain there of 2.2%. So the Dow back above 30,000 at 30,038 today. The S&P 500 index snapping a 6-day sell-off. 10-year yield 3.95%, 2-year yield 4.46%. Spot gold 16.66 the ounce, down 0.4%, while West Texas Intermediate crude up 2.3%, 89.25 a barrel. So what about the turnaround on the CPI Thursday? Dave Donabedian is Chief Investment Officer at CIBC Private Wealth Management. He was our guest right here on Bloomberg Business Week.
The timing of the move, late morning, it was a rather sort of violent turnaround to the upside, and usually that suggests some kind of programmatic or algorithmic buying. So I think that's part of the story.
Netflix shares up 5.3% today. Netflix will introduce an ad-supported plan on November 3rd, charging $7 a month for a subscription. Relmada Therapeutics shares plunged today after experimental treatment for major depressive disorder failed to show a benefit in a late-stage clinical trial. Today we saw shares of Relmada Therapeutics plunge 79.6%. Recapping stocks higher today, the Dow, the S&P, and NASDAQ all bouncing back. S&P up 92, up 2.6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar, Tim Stanovic, right here on Bloomberg Business Week. Our next guest spent years working at several iconic Wall Street firms, former Goldman Sachs managing director, former senior managing director at Bear Stearns over in London. Before that, Lehman and Chase Manhattan. Nomi Prinz is an economist. She's also an author and an investigative journalist.
She's also the author of several books, including her newest, Permanent Distortion, How the Financial Markets Abandoned the Real Economy Forever. She joins us live in the Bloomberg Interactive Brokers studio this afternoon. Nomi, congratulations on the new book. Just came out on October 11th, so it's been out for a couple days. We're going to talk about the book. We got a great chunk of time with you, but given your background, your role as an economist, we got to get your take on what's happening in the markets right now and what's happening in the economy. I mean, a wild day on Wall Street where we saw markets open down more than 2% and then end up finishing the day close to session highs. What's going on here?
Mass insanity in the markets. I mean, what's happening right now is that the markets don't know how to process whether they're going to have sort of cheap money forever, whether the Fed's going to go back to sort of what it used to be like, whether it's going to continue to hike rates, how to actually interpret every little teeny piece of data. So there's no idea of forward-looking analysis in the markets right now. It's all reactive. And that's something that's very new to the period that we're living in right now versus when I was on Wall Street, when it was like, okay, this is what rates are. They go up, they go down. There's sort of a balance. But by the time we've gotten to this point where rates have been at zero for so much of the last 14 years, and now they're sort of moving up. But the Fed is still sitting on a book of almost $9 trillion worth of assets, and all the central banks around the world are in similar kind of positions. It's really hard to figure out where there's actually value in sectors, in names, and in the specifics of the market. So a lot of this is more knee-jerk reactive than necessarily forward analysis.
How should we think about the financial markets? Is it the real world, the real economy?
It isn't, and this is part of the process that we've been in since really 2008, and a little bit before that. I mean, we got into 2008 because in the beginning of the 2001, we had rates very low, we had mortgages going crazy, we had a subprime crisis, and we got this whole quantitative easing period that we are still living in right now. And we're not at the back of this by a long shot. We're like in the middle of potentially, QE forever, even if books come down by a little bit. And so what does that mean? It means the real economy doesn't necessarily get the benefit of financing the same way it used to get the benefit of financing in the 60s and the 70s and the 50s when we were building roads and highways, because it's come second to money being created quickly, being leveraged excessively, and flowing into financial assets that are quicker to turn around.
So wait, can I ask you something? So the sophistication of markets and how we can trade it and slice and dice it, is that why you're saying it's just a whole different game on Wall Street versus years ago, decades ago, when it really was reflective of what was going on in the economy?
Well, there was certainly more information that was coming from the direct economy through companies that were involved in creating different components of the economy and being more directly related to individuals.
Right.
And now, of course, we have much more technology, much more analysis, but we also have far more leverage. And so we combine the technological leverage with the financial leverage. We have this complete disconnect between, again, money going into the economy and sticking around and being used for longer term capital investments and creation and all of that, relative to I'm here now, I'm there now, I'm trading on momentum, I'm trading on technological factors, I'm trading on computer science, and I'm not necessarily trading on value and the long-term view.
You said something that makes me think about the role that government takes, because when you think about big infrastructure projects in the 1950s and 1960s, you think about the post-World War II boom here in the United States, the building of Levittown, for example, all of these like shovel-ready projects. That's something that you need to have, widespread agreement on when it comes to putting that, implementing them. We don't have that right now. It's all a joke. It's always infrastructure week, right, in Washington, and nothing ever gets done. Is that a big obstacle to kind of getting past where we are, the financialization of the economy?
That's a really good question, and it's true. In the 50s and 60s, we had a connection in politics that related to the connection of what was needed to be done in the country. The building of those highways, the building of the space program, the building of permanent, lasting features. We even had that in the 1930s. The Hoover Dam was built in the middle of the Great Depression because it was a process that had started and it had financing, and it retrieved that financing throughout all the years that it took to build it. So there's a lot of longer-term thinking and longer-term capital commitment in those days, not just from the direction of Washington. It had that too, but also from the direction of private industry, from Wall Street, from companies throughout the country. There was a collaboration that has really become disintegrated now.
We can't even build a tunnel between Manhattan and New Jersey.
Right.
We can't. We haven't been able to do that.
And there's an incredible need for it. Sit tight. We have to do some news, but we want to come back and talk a little bit more, because I also do wonder, something Tim and I talk a lot about, the role of kind of private markets and private capital, where there's so much going on, and I feel like it adds to the distortion that we're seeing that you're talking about. We're going to come back with Nomi Prinz. She's an author. She's an investigative journalist. Spent a lot of time at the well-known, Wall Street firms over in London as well. Her book, Permanent Distortion: How the Financial Markets Abandon the Real Economy Forever. And I feel like this fits into so many things we talk about.
Well, let's get to world and national news. For that, we turn to Nancy Lyons. She's standing by right now in our 99.1 studios in Washington, D.C. Hey, Nance.
Thanks, Tim. President Biden says even though inflation is still high, his economic policies will help the U.S. handle the uncertainty. The Labor Department says the Consumer Price Index shows the rate of inflation last month was 8.2%, down slightly from the month before, but prices for virtually every good and service is higher than it was last year.
Because of my economic plan, we are better positioned than any other major economy in the world to weather the challenges that come through this as a stronger country. We've created nearly 700,000 manufacturing jobs just in the last 19 months.
Biden spoke in California at an event to promote his infrastructure plans in Los Angeles. While the midterm race for control of Congress is getting tighter.
A new CNN poll shows 50% of voters prefer the Democratic candidate in their congressional district compared to 47% for the Republican. In competitive districts, though, it shifts the other way. 48% of likely voters prefer the Republican candidate in those tight races. 43% go for the Democrat. The poll finds 32% of voters think Republicans have a clear plan to solve the country's problems. 28% say the same about Democratic candidates. In Washington, Washington, I'm Nathan Hager, Bloomberg Radio.
The House January 6th committee has voted to subpoena former President Trump. Lawmakers want to question him about the 2021 attack on the U.S. Capitol. It's a dramatic development as the committee winds up its investigation. The panel's vice chair, Republican Liz Cheney, referred to the former president as January 6th central player. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Thank you so much for that update, Nancy Lyons. Tim Stanovic and Carol Massa. We're live in the Bloomberg Interactive Brokers studio in New York. We've got Nomi Prinz with us. She's an author and investigative journalist. She's got the new book out, Permanent Distortion, How the Financial Markets Abandoned the Real Economy Forever. She was a managing director at Goldman Sachs. She ran the International Analytics Group as a senior managing director at Bear Stearns. She was a strategist at Lehman Brothers. She was also at Chase Manhattan Bank before that. She also was on Senator Bernie Sanders' Federal Reserve Reform Advisory Council. Nomi, what I want to talk to you is about how you made the transition from banking into becoming an author, an investigative journalist. Like, why did you leave the industry?
Did you run from the industry? No, just kidding.
9/11 had two things happen from the industry. Right, 9/11 happened. I was at Goldman Sachs corner office, and 29th floor, the whole thing that was going on at the time. And at the time, also there was a lot of corruption that was happening on the corporate side. That was sort of when Enron was breaking. That was when WorldCom was breaking. There was a lot of tension in terms of what the reality of balance sheets were, what the role of Wall Street was, and of course what we found it to be in all those corporate scandals. And I was seeing a lot of that and getting sort of very disgusted with a lot of that. And then of course 9/11 happens, and sort of add one and one get two, and two is basically I need to go and I need to talk about this stuff. And so a lot of the first writings I did were about what was going on in terms of the corporate scandals, the telecom sector, the energy sector, and Wall Street's connection. And I wound up taking that route into my first book, Other People's Money, The Corporate Mugging of America, which also talked about the innards of Goldman Sachs as well as the banking industry and everything that was going on there. Because I thought at the time nobody was talking about it. I mean, at the time, we couldn't even talk about being inside Wall Street. It's not like today where everybody's talking sort of about everything all the time. It wasn't like that. It was very much a sort of more secretive sort of situation, and I needed to talk about it. So I needed to be outside to talk about inside.
I was going to ask you if it's better, but I've only got 20 seconds left here, so maybe we'll do it on the other
You
side.
can do yes or no.
Is it better today? Yes or no? Or quickly, about 10 seconds?
It's not. Okay. It's more confusing today.
More confusing. All right. We're going to continue this conversation. Nomi Prinz is going to stay with us. We're talking about her new book, Permanent Distortion. And this is Bloomberg Business Week on Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. It was an up day, and that's putting it mildly for the Dow. The S&P and NASDAQ U.S. stocks came roaring back today after an initial sell-off sparked by this morning's CPI report. S&P 500 index today up 92 points, a gain of 2.6%. The Dow back above 30,038, up 827 points, up 2.8%. NASDAQ up 232, a gain there of 2.2%. 10-year 3.94%, 2-year 4.46%. Spot gold down 0.4%, 1666 the ounce. Bitcoin today right now up 1.1%, 19,381. And a surge today for West Texas Intermediate crude up 2.3%, 88.29 a barrel. Bottom line here, an advance, a solid advance for the Dow, the S&P, and NASDAQ. Bank results will give clues about the market's next move tomorrow morning. Among some of the names about to report, J.P. Morgan Chase up today by 5.5%, Citigroup up 5.2%, Wells Fargo 4.6%, Morgan Stanley up by 3.5%, and we will have you covered on those bank stocks when we get those earnings tomorrow morning. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. I want to get right back to Nomi Prinz, author and investigative journalist. Google her because her background's incredible. She's got a new book out, Permanent Distortion, How the Financial Markets Abandoned the Real Economy Forever. Permanent distortion, why is it permanent?
Excellent question. It was not taken lightly because I like words as well, being an author. It's because in the wake of the financial crisis, when we went down to 0% interest and we created $4.5 trillion worth of money from nowhere to take debt out of the market. At the time, U.S. debt in general was $9 trillion. $4.5 trillion equivalent was on the Fed's books. Some of that was mortgages, treasuries, but it was all connected. Then we had a double down situation that happened in 2020. So the period in between, there was a lot of speculation. When will the Fed raise rates, et cetera? They raised in 2015. Markets were insanely negative on that whole prospect. They didn't raise again until 2016, and then sort of bits along the way to 2019. Turned around in 2019, end of 2019, because Wall Street collateral wasn't working between Wall Street and its own customers.
Right.
The repo markets were falling apart. So the Fed turned around and created more QE, brought rates down again, talked about it as if it was related to the economy, but in fact it was related to liquidity on Wall Street, which, by the way, right now we're going to see a lot of problems, I think, coming into tomorrow's numbers. But besides that, when we got into 2020, just a few months after that, and the pandemic hit, that's when there was an overdrive factor, and that's when the Fed went to $9 trillion from, at the time, 4.1, but effectively doubled in a few months what it took a number of years to get to the first time.
Yeah.
Other central banks around the world followed, and what became just a sort of help, which was enormous to begin with, became a permanent artificial cushion to the markets. And even right now, even with rates coming up now and all the speculation of the Fed's, totally changing and it's going to be this inflation hawk, even though it can't fight a lot of the inflation it says it's trying to fight, it doesn't actually change the fact that this cushion is underneath all the financial markets. And that's why we have days like today, where the market basically spans 1,500 points in a day on the Dow. That's not normal. That's not healthy. That's related to the speculation versus this permanent idea of this distortion between where the money goes to the real economy, how it gets to the markets, and where it stays. It's not a question of blaming the Fed. It's a question of the Fed is responsible for creating the cushion. So I blame the cushion. The Fed created the cushion. So in that respect, yes, I do blame the Fed. But you have to look at the bigger picture.
Yeah.
Not just what is the Fed doing now with interest rates that obviously is creating uncertainty in the markets, and it's certainly oppressing people trying to get mortgages right now, which are twice as expensive as they were 6 months ago. And that's a really quick change if you're trying to budget and you're at the bottom level of your own, sort of the economy. But this is more about the fact that that cushion exists. It's not just the Fed, it's the Bank of England, it's the European Central Bank, it's the Bank of Japan, it's the global central bank network that has basically created this outside source of capital in order to be there when it deems necessary. And that uncertainty about what's necessary is now what's permeating in the markets, and it's a reason why capital can't go outside those markets when they're going up or when they're going down to long-term projects and to the foundational economy to the same extent as before.
When did this start? I mean, would you say that this was in the wake of the great financial crisis, or was this happening earlier?
It was happening a bit earlier, but quantitative easing, to the extent that we saw it, and we see it now, and the doubling since the financial crisis, was a post-financial crisis phenomenon. You know, we had a situation where the entire banking system was so over-leveraged, and all of the customers of all of the over-leveraged mortgage product were facing, you know, potential margin calls and everything else out the whole system, from the top on all the way to the outskirts. And so from that point on, when the Fed decided, okay, Ben Bernanke just won a Nobel Prize for not noticing this happened in 1927 into 1929, because we had a home bubble then too. But the point being that this created this momentum in the fabrication of money that had not existed ever before. Japan kind of did it for a while, did it since the 90s, but nowhere near to the same extent that the Fed did it, and then every other central bank in the world followed. And so again, this became a global situation where the global cost of money was zero and the global cushion continued to grow. And that happened in the wake of the financial crisis.
So as a result, those who have access to that cushion, basically, and that velocity of money, have really benefited in a big way. And hence we have this massive gap in society that just gets bigger and bigger in terms of wealth.
That's right, because obviously if you're in the market and you can leverage yourself into the market, that's whether you're a wealthy individual,
right,
the CEO of a company that buys a lot of its own shares or has the benefit of other leverage coming into that particular company or any of the financial markets, those have this buzz up. Again, right now there's a little bit of uncertainty, but for the most part, they have had this the acceleration, I would say, of the velocity of money. So basically, this swoosh of money going into those areas, and therefore, money has choices. But money goes, and I talk about this in the book, that if you visualize where money is going, money is flooding into the place where it can go most easily,
right,
and where it can stay most easily, and where it can have the greatest impact. And that means that anyone using it, anyone leveraging it, anyone that has access to it gets that benefit, and anyone who doesn't simply doesn't. And as a result, that gap widens and widens.
We're speaking with Nomi Prinz, author and investigative journalist. She's got the new book, Permanent Distortion, How the Financial Markets Abandoned the Real Economy Forever. Nomi, how can banks better serve the real economy?
Banks can look at their balance sheet in terms of where their small business loans are. They can look at where they're paying people for the interest on their savings account. They cannot charge ridiculous fees relative to the amount of money that people have with accounts. Right now, for example,
they're
average,
not going to do that.
And they're not, well, yes.
Because
no, they're not. But it's a very good point.
The incentives aren't aligned for this, right? The incentives aren't aligned for this.
Well, exactly.
So that's
why
the problem.
So why would you? So in 2015, I had this conversation at the Fed. In 2015, I had this conversation, as I was saying, at the Fed, in front of the Fed, the IMF, and central bankers who are involved in this, you know, the annual meeting they have there. And the topic was, why isn't Wall Street helping Main Street? And I just got up and I said, because you're not making them. I mean, they basically have the benefit of all of QE, all of the loans, all of the help, all of the access to 0% money, and you're wondering why they're not sort of just giving it out to sort of little people that hold accounts with them. I mean, it's not really rocket science. They're not, because they don't have to.
I get the argument for why they should, because of the assistance they got from the government, right? And there are banks, as you know, you worked at Lehman, they're not around anymore, right?
That's right.
I mean, there are banks that are survived because of it. But I do wonder, as publicly held companies, they have got to constantly think about returns to investors. And that's why I think, I'm not pointing fingers or anything, but I mean, that's why they potentially don't do that. And we've just got about 30 or 40 seconds left here. So is there, you talked about, I don't know, what's the final takeaway for our audience?
Well, the final takeaway is that when I say permanent, I actually mean permanent. I don't think there's going to be a period where the Fed's book is going to go back down to the $800 billion it was before the financial crisis of 2008. Maybe it dibbles from like 9 trillion to 6-7 trillion, but I mean, it's still massive. And then again, you multiply that throughout the world. So what does that mean? That means going forward, we're going to have more and more of these volatile days to this magnitude. We're going to have more of these crises bubble. So it's not necessarily going to be one big thing. It's going to just be a volatile scenario, because there's a permanent distortion of where money is created, where it goes, who gets it, and who doesn't, which is in the real economy.
There's going to be always a cushion out there floating, and it's massive. Nomi, come back. Please, Nomi Prinz, author, investigative journalist, so much. Permanent Distortion, How the Financial Markets Abandoned the Real Economy Forever. Great conversation. If you missed it, check out our podcast feed on Bloomberg.com.
That's it.
We got to run. Crazy day. We'll see you tomorrow.